Have you ever seen people posting gains online such as this or even this and wondered, is this even legit? Can options really earn me this amount of money? If that is you, then I will encourage you to stick around, as I will be breaking down the basics that you will need to know when buying an option. And to keep this as holistic as possible, I will also go through the risks of buying an option. Hi, my name is Darren and I have been investing in stocks and options since university. The main aim of my videos are to educate new investors on the various financial instruments out there so that we all can achieve financial freedom together. However, just a little disclaimer, these sharings are based on my personal learnings throughout my trading and investment journey. All I aim to achieve is to share whatever knowledge and mistakes I have made over the years to you guys and be a blessing. So, what is an option? An option is a contract that gives the owner the right but not the obligation to buy or sell an asset, which in our case is a stock, at a fixed price on or before a predetermined date. In summary, there are two types of options. We have a call option and we have a put option. So what are the differences between the two? A call option is a contract that gives the option buyer the right but not the obligation to buy shares at a set price on or before a predetermined date. A put option, on the other hand, is a contract that gives the option buyer the right but not the obligation to sell that shares at a stipulated price on or before a predetermined date. So in summary, you will generally profit from a call option when the price of the stock goes up, and you will generally profit from a put option when the price of the stock drops. So some things to note. In an option, there is also a strike price. This is the specific price that one can buy or sell the underlying security. There is also a fixed expiration date in an option contract. Most options tend to expire on the third Friday of each month. However, the introduction of weekly options now ensures options that list on Thursdays and expires the following Friday. With this in mind, how do we read an option chain? Let me take out an option chain now for easy reference. So this is an option chain that was extracted from my Think or Swim app. The first thing that we will notice is the ticker symbol, and that will be the SPY symbol that is shown at the top. I would like to bring your attention to the two columns, which is the calls and the puts. We will look at the calls section if we want to buy calls and the put section if we want to buy puts. The next thing we will want to take note of will be the expiration date, and that will be this date right here. As you can see, the expiration date that we are currently looking at is the 17th of December 2021. The 23 next to it just means that there is 23 days left till the option expires, and 100 means that this contract controls 100 SPY shares. The next thing to look out for would be the strike price, and the last thing to note would be the bid and the ask price. The bid price here will refer to the price we would get if we were to sell that particular option now to the market, and the ask price here will refer to the price that we would get if we were to buy that particular option at the market now. Okay, so let's put all this to practice. If I want to buy a SPY call option that expires on the 17th of December with a strike of 469, then it will cost me $5.83 times 100, which is $583. Now you may be wondering, why must I multiply it by 100? The reason is because one option contract controls 100 shares. An option can also be either 1 in the money, 2 at the money, or 3 out of the money. So let's talk about in the money. When your call option is in the money, the strike price of your option is below the current trading price of the stock. This means that the option buyer can exercise the option to purchase the stock at the stipulated strike price and purchase the shares at a price that is much lower than its current trading price. When your put option is in the money, the strike price of your option is more than the current trading price of the stock. This means that the buyer can now exercise the option to sell the stock at a stipulated strike price, which is much higher than what it's currently trading right now. So you guys good so far? Feel free to drop me a comment if there's anything you need help in, and I will try to respond to it personally. Now let's talk about at the money. When an option is at the money, the current strike price of the option is equal to the current trading price of its underlying security. Now on to out of the money. When your call option is out of the money, the strike price of your option is higher than the current trading price of the underlying security. And when your put option is out of the money, the strike price of your put option is lower than the current trading price of the underlying security. The premium of an option is derived from 1. Its intrinsic value, and 2. Its time value. Options that are out of the money have no intrinsic value. The intrinsic value of an option is basically the difference between the price of the stock and its strike price. Time value is basically the amount that an investor is willing to pay above its intrinsic value. As options decay over time, hence the more time that remains before expiration, the greater the time value of that option. With this in mind, therefore, options that are in the money with a long expiration date tend to cost more as compared to options which are out of the money with short expiration dates. Okay, now that we know what a call and put option are and how to read that option chain, let's talk about what affects the price of options. And there are three main factors. The first is volatility. Stocks that experience huge fluctuations tend to cost more than stocks which do not fluctuate much. Second is the price of the stock. As a stock starts to go in the money, you will notice that the price of the option will increase. The reverse is true if your stock starts to go out of the money. You will notice that the price of your option will start to decrease. And third will be the time left till expiration. An option that has a lot of time left till it expires will cost much more as compared to one that just has a few weeks to expiration. Now that we know the basics of options, let us now address the million-dollar question. How much can I lose when I buy an option? If you were to buy an option, be it a call option or a put option, the maximum that you will lose is the initial capital that you had laid out to purchase the contract. And the sky is the limit with regards to how much you can potentially earn. If that is the case, why do people always associate options as being a risky instrument? This is because most people have the tendency of buying short-dated options. These are options that expire within the next few days. The pros of buying such a short-dated option are mainly because it's cheap. This is because there is very little time priced into the option premium, and if the stock were to move in the right direction, then boom, you could potentially earn this or even this. However, if you were to guess the direction wrongly, then the value would decrease drastically, and if it were to expire worthless, then you have lost every single cent placed in that trade. And if you are someone who likes to go all in, then one wrong trade can wipe out your whole trading account. Of course, naturally, the safer approach would be to buy options with more time till expiration. However, do note the premiums for these options can be very expensive, and that is why it is so hard to grow a small account. Each trade is so risky that one wrong move can just wipe out the entire account. Okay guys, now that I have covered the basics of options to you, I would like to pass a question over to you guys. What type of stocks are you planning on buying options on right now? Let me know in the comments below. And if you have been getting value from this video, please hit that subscribe button and smash that like button. See you!